Let's welcome on board Sanjay Mookim then and chat about where he sees the markets headed. Sanjay, hi, good morning. Good to have you on the show. Upgrades galore, and so is the FII money. Month to date, we're already almost inching closer to the historic levels. Where do you think the markets are headed, and whether the market has further headroom to go from the 13,100 top that we clocked yesterday?
Well, look, morning, good to be on the show. I think what we've seen in the last few weeks really is the collapse of volatility across equities globally. See, getting into the US election, walls were very high. And as the results have been clear and it seems that the transition is happening, the volatility has come down, which has driven markets up. And to my mind, at least the near-term collapse, the near-term boom that we had to do that seems to be over. There is a consensus building somehow that 2021 will see a significant depreciation of the US dollar. And I think people then extend that to EM flows, to EM equities doing well. And if that were to play out and the dollar were to depreciate significantly, then you could see surprisingly strength to EM and Indian equities, even though we are at all-time highs already.
Okay, Sanjay, hi there. Good morning. We just wanted to get in your take as to what exactly you're making when it comes to, the financial space, because we have seen, the sort of correlation, the weightage of the Nifty Bank as well, in tandem with the way the rest of the market has been moving. And just wanted to know what your stance is when it comes to this space. Are you comfortable with some of the private sector banking names vis-a-vis going for the NBFCs, insurance, or even public sector counterparts?
Look, I split it into two parts. We've been saying as a house for some time that the loan losses and slippages for banks in India as a consequence of the lockdowns are unlikely to be very high. And that seems to now have become accepted narrative by most investors. Right? People were worried that the lockdowns would lead to slippages, that even the bank managements are now very vocal saying it's unlikely to happen. To my mind, a lot of that surprise is already in stock prices. The next leg of rally or up move for banks will have to be driven by growth. That is the next big question for financials. In this sort of an economy which is still healing, that's the right word, how do financials outperform the system? How do they continue to maintain the strong growth that we expected of them? And to my mind, financials or private financials which are able to stand out, deliver that high double-digit growth, will be the stocks that outperform here on. And if that's the framework, then you have to look for private financials which have lower cost of funds, which have the risk appetite, which have the liquidity to continue and lend in this environment.
Sanjay, we'll be focusing very closely on the PSU space, and interestingly, we'll have some, more focus with the PSU reboot, because there has been a lot of thrust from the government on this front. But your view is that we are likely to see the ETS selling as an overhang on the PSU basket. But are you being selective? Are you sensing some sort of opportunity within the PSU space, and where would that be?
And the argument I've made is that the PSUs appear cheap on headlines. Many of them are trading at 6-8 times PE. But this is not mispricing, because most of the PSUs are resource companies, and resource comparable valuations in the region have also fallen. And the right way to look at many PSUs is to look at their EV/EBITDA multiples, their balance sheet included. And in that respect, some of the de-rating has been justified, because many PSUs have levered up a lot. They've been paying up a lot of dividends. They've been still maintaining their CapEx programs. So adjusted for the balance sheet deterioration, the valuation of the PSUs is fair. It's not underpriced. I don't think there's a value trade coming. But the flip side is that it therefore means that a cyclical trade is still possible. There's no mispricing or incorrect pricing of the PSUs. A cyclical upside is still possible. And within that, we actually like to steal and coin sort of names amongst the PSUs.
Okay. Sanjay, earnings have been pretty encouraging this time around. And while there have been a lot of cost cutting and efficiencies that have kicked in, that's being lauded here in India, Talk to us about some of those earnings upgrades, revisions that perhaps has stood out to you, and what confidence that gives you in the second half.
This is a bit of a glass half full, half empty argument. Yes, companies have done better in the short term, driven primarily by the fact that we've seen cost savings and somewhat due to the pent-up demand that is coming through as the economy is opening up. However, when you're looking at upgrade, you should look at 12 months forward up. I don't think stocks really move in line with what happens with a 1 quarter number. And the problem for a 12-month out or an FY22 outlook is that the expectations are already very high. And for many of the large cap stocks, despite the beats we're seeing in the short term, we're actually still worried about downgrades for the 12-month forward on the FY22 number, simply because people have put in a lot of expectation going forward. The other argument we make is that if the economy were to open up, several of these cost savings that have been accrued now will not be retained, either because of competition coming back or because of normalcy in activity. These cost savings will have to be given back up, and then much of that margin expansion will go away. So again, if you put all of this together, the outlook for 12-month forward FY22 EPS is pretty negative, actually.
Okay, so that's actually not sounding as optimistic. So to combine that with the current fears of potentially any extension of lockdown, at least in the next few months until we have the vaccine here and within reach, does that lead to a more cautious approach then? Is that what you're saying?
There's two ways, right? If global equities continue to rally because of some policy action by developed countries, then Indian equities will get dragged up. That will be painful because many investors find the valuation and trajectory of these companies difficult to explain. But to my mind, the near term, say next 3-4 months, behavior of the index in India is completely dependent upon what happens to EM equities or global equities. Even this year, YTD India has almost mirrored what has happened to MSCI EM, for example. And that's a very difficult call to make. You will have all these discussions of the stimulus in the US and so on, which will matter. However, the bottom up, if the economy is still gradually getting back up to speed, what you will argue is that fewer companies will be capable of driving upgrades because consumer confidence is weak, business confidence is weak. Most people are in a mode to save cash and improve their balance sheet, which does not make for very strong and robust economic recovery to my mind. And therefore, the job of an investor is to figure out which of these two companies in India are capable of beating or surprising their earnings. And that's where the investment portfolio will have to be focused.
Sanjay, what one has seen is that the earnings revival has kick-started from Bharat or rural India. You talk about FMCG plays, you talk about some of the paint companies, you talk about autos like an M&M, Escorts. They all indicate that it's the rural end of the economy which is thriving, and that's where there is visibility as well of further earnings headroom. Do you also believe that tactically one needs to have a larger exposure to the rural dominated plays, at least till you have a pan-India recovery for the virus?
Yes, so this is a bit of a contra reopening play. See, what we've done a lot of surveys ourselves. We've spoken to small businesses, we've spoken to retail consumers. What seems to be happening to some effect is that all this reverse migration that we saw of people moving back to their villages has led to increased expenditure in the villages, at least in the short term. Because many of the migrants who've been sitting at home have undertaken home improvement projects, bought some cement, bought some roofing sheets, and so on and so forth. So if you do see a reopening up of the economy, you may get this reverse migration coming back in which case some of the rural momentum may be lost as well. You would also argue that with time, the savings of these people who migrated back to villages will get eliminated or extinguished, in which case then the spending power will also fall. So I think that, look, the rural economy outperforming the urban economy is specific, driven by the dynamics of these migrations and the lockdowns. It's not sustainable to my mind, but at least in the near term, that seems to be outperforming and being the one part of the market that people can still stay in the
Yeah, absolutely. Sanjay, you've mentioned as to how critical it is for banks to actually hold out and financials to lead recovery. You earlier highlighted as well your thoughts on banks, but tactically, what makes more sense right now to have exposure to? Would you say continue to bet on the economic revival and therefore banks with a larger corporate book are going to lead from here, or would you say continue to stick with the large, retail-dominated banks within the private banking space?
So let me answer that the other way. One of the big things that is happening in India is this huge fall in nominal and real interest rates. If you look at what's happening to short-term rates in India, for example, or even real rates, and inflation is relatively stubborn, these are relatively negative. And this will change consumer behavior. I mean, your post-tax fixed deposit returns in India are now only 3%. What are you going to do with the savings? Whoever has income today has savings and has little return on the savings today. And in this environment, it is proven historically that more savings will move to real assets, such as real estate or gold and so on. So there is a natural demand, to my mind, for mortgage-related products. And we're already seeing momentum in that from bank commentary point of view. And so to my mind, banks have really two kinds of choices to make. Right? Either you start taking your duration risk, which is take longer duration asset, benefit from the pickup on the yield curve, or you start taking credit risk. And to my mind, banks are likely to take a little bit of the mortgage risk and duration risk. And therefore, banks which are willing to lend to those kind of customers might see more higher growth than those that are not. So to your question, the answer would be still a more retail-focused, mortgage-focused sort of banking system, which is able to benefit from this natural demand coming in at the moment.
Just to stretch that point further, Sanjay, just if we take a look at India Inc.'s earnings so far, while there has been a meaningful recovery kicking in the quarter gone by, that's largely been on the profit front on account of lower costs perhaps, but we haven't, seen a complete recovery when it comes to the revenues. Do you think that this is going to hamper the company's prospects to expand their operating margins further, particularly for the likes of auto, etc., because urban demand continues to remain somewhat muted?
Yes. So this is the classic debate between flow and state, right? Yes, the operational utilizations are improving across the country. People have gone from 40% utilization to 90, 100% utilization, even higher. But to grow, to do capex, to meet my earnings forecast, these companies or the economy needs to be at 105, 107% of utilization. That's when you will drive capex and expansion of the economy. And this, to my mind, is more like, is not linear. It's more like a project S-curve. The easy part, which is going from 40 to 90, 95 is done. The tougher part is getting the economy utilization from 95 to 105, which will take longer than people imagine. Because even with the vaccine, there will be a corner of the economy which will remain suboptimal, which will take time to come back. And that's where I think we are set for a bunch of disappointments across many companies that with the easy recovery is done. The harder bit, which is the last 10% or something like that, is going to disappoint people. And that's where I worry that in many cases, the expectations have become too robust.
Right, and if we were to, just talk a little bit about the kind of movement that we've seen in some of the FMCG space or, the consumption space as a whole, you have seen a fairly encouraging move coming in. The fact that a lot of the corporates as well are talking about, growth recovering as things are gradually opening up. Is this a space, despite the compelling valuations, that would merit a look?
So I split it into two parts. If you look at the discretionary names, let's say the autos, for example, valuations are not compelling. I mean, these companies are trading a pretty fancy price to earning multiples already. And this is on the assumption that growth will continue to recover from where it already is today. Right? People are building in further recovery from where we are. And this is where I am a little bit circumspect, because much of the improvement that we've seen in the auto sales, for example, seems to have come in from pent-up demand accumulated over the last few months. The surveys we've done, the channel checks we've done, all tell us that consumer confidence is pretty poor and pretty weak. So the sustainability of this recovery momentum for autos, which are really expensive stocks, impact. Now looks very difficult to me, and that's why we kind of underweight that sector. The FMCG front, there seems to be genuine volume improvement. All our channel checks again, there confirm that there is, even without price increases, there is genuine natural growth to demand, which is fairly encouraging. The problem for many of the FMCG companies really is that the entry multiples are very high, which is kind of puts people away or people off for some time. But I think that between the two, the FMCG sort of staples look better positioned to deliver top line than the discretionary.
Okay, Sanjay, so there definitely seems to be a tilt more towards, more towards the cyclicals. Tell me, within the PSU names that you mentioned earlier, is it a commodity play or would it be a PSU play when you're talking about a sale, when you're talking about ONGC?
Well, I won't refer to any specific company, but look, the argument is that commodity prices have improved, let's say, on the ferrous side. Steel, for example, is done well in India. And if these prices were to sustain for some bit longer, then the EBITDA for these companies will continue to spike. Expectations are low, and the surprises may come through. So it may be a short-term cyclical trade. And my argument is this is not because this is a PSU, it's because it's a commodity company, and we are not immune from upsides to commodity prices. The reopening of the global economy could drive oil demand higher. And in conjunction with whatever action OPEC is willing to take, you might see a stronger oil price, which would be good for even Indian public sector oil companies.
Okay, and within the industrials, materials, that segment as well, given that you're still a little cautious on the recovery going forward, is this a segment though that you feel will still, will still see growth now, given that the government's also intent on kind of making that happen?
Well, yes, we are a little bit cautious there. The argument being that, look, the government should consider stimulus. They acknowledge the need for it, but are really hamstrung by the very tight financials they've already done. Revenues are down a lot, expenditure has gone up because of whatever incentive and stimulus the government has undertaken. I don't see there any room, at least for the next several quarters, for an acceleration in government capex, which is the principal driver of infrastructure spending in the country at the moment. So even though the multiples there do not look very challenging, I think that the top line or order flow momentum for many of the industrial companies will likely to remain weak for some time. So we are underweight that space.
All right, Sanjay, thanks so much for joining us. Keep an eye on financials and still a little cautious. That's the word coming in from Sanjay Mookim. Thanks for being with us this morning.
Thank you.
We're going to take